Welcome to vTalkInsight, Allocator's lens daily for February 10th, 2026. Across assets, the tension today is between an AI-driven productivity boom, softening labor data, and rising political risk around central banks, all while capital rotates from expensive tech into real assets. Let's start with equities, where that rotation and the durability of earnings are now front and center for portfolio risk. In equities, the headline is that index levels remain close to highs even after a sharp tech wobble, because leadership has broadened well beyond the mega caps. Equal weighted versions of the S&P have recently outpaced the cap-weighted benchmark by the widest margin since 2020, and cyclicals, industrials, financials, and even small caps are taking a larger share of the gains. Much of that is underpinned by strong fourth quarter reporting, with around 60% of the S&P showing solid earnings and revenue growth, and management guidance early in the year generally supportive. Beneath the surface, AI is reshaping both the profit story and the leadership board. On the macro side, a surge in productivity linked to AI tools is boosting corporate profits and gross domestic product, but allowing slower job creation without immediately signaling recession, which helps justify higher earnings expectations. On the micro side, large tech firms are sustaining double-digit earnings growth only by massively increasing capital expenditure and issuing ultra-long bonds to fund data centers and infrastructure, shifting them away from the old asset-light model and putting free cash flow margins under pressure. That shift has triggered valuation debate around AI-exposed names, with some investors treating current multiples as the start of a new paradigm, and others worrying that elevated capex and uncertain monetization could eventually force a correction. Within technology, there is now clear dispersion rather than a single AI trade. Software as a group is technically oversold after a severe drawdown, yet the sector just delivered its strongest earnings per share growth in more than 2 years, suggesting sentiment is lagging fundamentals. And some names such as Salesforce and ServiceNow are seen as central to the AI transition with upside that is not fully priced. Chipmakers tied directly to AI infrastructure, like NVIDIA and Broadcom, have seen bouts of weakness and quick rebounds as investors reassess how much of the data center boom is already discounted, while networking and memory companies are reporting significant earnings beats and upward revisions as hyperscaler capex accelerates. Outside the United States, European equities, particularly in Germany, are getting a boost from expected fiscal spending on defense and infrastructure, and Japanese stocks have surged on a landslide election and promised stimulus in AI, defense, and construction. At the same time, positioning and policy are adding two-sided risk around that constructive earnings picture. Trend-following funds are flagged as potential foresellers of tens of billions of dollars of U.S. equities if key index levels break. Hedge funds are running record short exposure after recent turbulence, and options volumes have spiked even in defensive sectors as investors seek both hedges and yield. Macro expectations are also stretched, with bullish GDP forecasts and a widely discussed target for the S&P well above current levels. So any disappointment on growth, payroll revisions, or the timing of Federal Reserve rate cuts could quickly feed through to multiples, especially given unresolved questions around future balance sheet reductions. For allocators, that sets up an equity landscape where breadth and earnings are supportive, but valuations, AI execution risk, and central bank politics leave a wider range of outcomes, making cross-market and cross-sector diversification more important as we look toward the next set of data and Fed communications. Turning to rates, government bond markets look deceptively calm, but the balance of forces is unusually delicate. The Federal Reserve is juggling inflation that remains above target with a labor market that is clearly losing momentum. As jobless claims rise, private sector hiring outside healthcare has fallen, and officials warn that forthcoming payroll revisions could show far weaker job growth than previously reported. If incoming data roughly match current expectations, some observers see scope for the next Fed chair to guide policy rates gradually down toward around 3% over time, with a June cut seen as possible if payrolls and consumer prices both surprise on the soft side. Against that easing narrative, structural headwinds are building at the long end of curves. China is steadily reducing its treasury holdings and has reportedly told domestic banks to cap U.S. government bond exposure, fueling worries about concentration risk and upward pressure on long-term yields. At the same time, as large fiscal deficits and more issuance from other major sovereigns invite a return of bond vigilantes. Yet foreign demand is far from collapsing. Overseas treasury holdings are at record highs above $9 trillion, with buyers such as the United Kingdom, Norway, Canada, and Saudi Arabia offsetting reduced Chinese demand, and recent U.S. auctions have cleared with robust bid cover. The result is a 10-year yield that has stayed range-bound near 4.2%, even as real rates sit well above pre-pandemic levels and markets accept that rate volatility is likely to remain structurally higher than in the era of zero or negative policy rates. Layered on top is a rare degree of political risk around central bank leadership and independence. Senate gridlock over the Fed chair nomination, the possibility of an acting chair being installed without confirmation, and talk of a new accord tying the Treasury and Fed more closely on balance sheet policy all raise questions about policy continuity and the term premium that investors demand. Globally, markets distinguish clearly between jurisdictions, with long-dated German bonds seen as relatively attractive thanks to steep curves, notable term premium, and a strong perception of European central bank independence, while UK gilts carry an extra risk premium tied to domestic politics. And Japan faces its own trade-off between fiscal expansion and a very gradual Bank of Japan normalization path. For multi-asset portfolios, that means the level of yields is only part of the story. The shape of curves, the source of term premium, and the credibility of institutions are becoming key differentiators to watch. Credit markets remain a source of relative stability, but they are being tested by a flood of new paper linked to the AI build-out and sovereign financing needs. Large technology companies with strong balance sheets are issuing ultra-long bonds, in some cases out to 100 years, to lock in borrowing costs and fund massive capital spending plans, and investor demand so far has been robust, with heavy oversubscription and tight pricing. Alongside that, overall investment-grade supply is surging, with expectations for tens of billions of new issuance in a single week, on top of elevated treasury auctions and a busy calendar of initial public offerings, raising the risk that any notable deal failure could spark a bout of market volatility. The AI theme is also creating more dispersion in credit quality. As investors grow more selective about AI beneficiaries, spreads for some hyperscalers have widened modestly on concern about overinvestment and long payback periods, even as their free cash flow and net cash positions remain strong on an absolute basis. Private credit that financed software and growth stories at peak valuations looks more vulnerable after the equity repricing, while commercial real estate lending shows a bifurcated picture, with office loans in New York returning toward historical norms and San Francisco possibly past its trough, but older, lower-quality buildings still under pressure. At the household level, a K-shaped recovery is evident, with high-income consumers filling luxury hotels while lower-income segments see rising delinquencies, a mix that could start to feed through to certain consumer credit books. Despite those pockets of stress, public investment grade and much of high yield still trade with relatively tight spreads, supported by the same robust foreign inflows that are supporting U.S. equities and treasuries. Yield harvesting strategies, including selling options for additional income, remain popular even in choppier markets, which reinforces the bid for carry but can add to volatility when risk sentiment turns. For allocators, credit continues to act as a partial anchor between equity volatility and rate uncertainty, yet the combination of heavy issuance, AI-driven sector concentration, and uneven consumer and real estate fundamentals argues for a more granular view of where that carry is actually being earned. In foreign exchange, policy divergence and politics are back in focus, starting with Japan. A historic election win for the ruling party has given the prime minister a powerful mandate to pursue fiscal expansion targeted at AI, defense, and infrastructure, which has driven a sharp rally in Japanese equities and a stronger yen as investors anticipate growth and more capital flowing into local assets. Markets expect the Bank of Japan to move only gradually on policy normalization. So the bigger near-term swing factor is fiscal credibility and potential intervention. Authorities are watching the exchange rate closely and are seen as likely to step in if dollar-yen pushes back toward the 160 area. That combination of supportive domestic policy and a perceived intervention backstop has reduced the tail risk of further extreme yen depreciation that troubled allocators last year. The British pound faces almost the opposite mix, with bearish sentiment dominating as hedge funds build short positions against a backdrop of a dovish Bank of England, expectations of multiple rate cuts toward 3%, and rising political instability that clouds the fiscal outlook. Those dynamics help explain why UK gilts trade with an added risk premium and why UK assets, those seen by some as fundamentally attractive on valuation and yield grounds, are vulnerable if political headlines turn worse or if the chancellor's position comes into question. Across the broader dollar complex, narratives of de-dollarization are fueled by China telling its banks to limit treasury exposure and by gold and other precious metals outperforming the greenback, especially when markets price in persistently easy U.S. monetary policy. Yet record foreign portfolio inflows into U.S. assets and all-time highs in overseas treasury holdings show that, for now, the dollar's role in global portfolios remains deeply entrenched, even as cryptocurrencies and metals continue to behave like high-beta expressions of shifting confidence in fiat regimes. Commodities are increasingly at the center of the cross-asset story, tying together AI, geopolitics, and fiscal policy. There is clear evidence of a rotation of capital from technology and asset-light sectors into energy and mining, with metals and mining equities up strongly year-to-date and energy shares also outperforming, while the Nasdaq has lagged. Years of underinvestment in extraction and refining, combined with policy-driven demand for electrification and data center build-outs, have left many commodity markets structurally tight, and major economies from the United States to China and India are actively stockpiling oil and metals, including through initiatives like a $12 billion U.S. program to secure critical raw materials. Copper offers a good illustration. Despite a notable drop in apparent Chinese consumption late last year, prices have held up as global inventories outside the U.S. remain low, supply growth is constrained by a lack of new large-scale projects, and AI-related infrastructure and grid spending support demand. Precious metals reflect both that resource tightness and broader concerns about fiscal and monetary regimes. Gold's powerful run since last summer appears driven less by central bank buying and more by investor anxiety over unsustainable U.S. deficits, fears of currency debasement as rate cuts proceed despite lingering inflation, and a desire for protection against policy mistakes and volatility. Speculative activity has clearly contributed, with Chinese trading volumes prompting exchanges to tighten margin requirements, and silver, in particular, showing extreme price swings due to thin inventories and increased financialization, behaving almost like a barometer for risk appetite similar to Bitcoin. That mix leaves gold and silver as potent hedges, but also as sources of mark-to-market stress when position unwinds or regulatory actions spark abrupt reversals. Energy markets add another layer of path dependency, especially around the Middle East. Some analysts argue that, beneath noisy headlines, recent inventory draws and years of underinvestment point to a structurally tight oil market that is vulnerable to upside surprises, while others highlight a current surplus and estimate that $6 to $8 of Brent's price reflects a geopolitical risk premium tied to the possibility of disruption in the Strait of Hormuz. Diplomatic talks between the United States and Iran have eased some of that risk premium and pushed prices lower. Yet traders remain wary of a kinetic incident that could cause a sharp short-term spike before any subsequent unwind toward lower levels, especially if Venezuelan supply continues to recover and add a few 100,000 barrels per day. For allocators, Commodities therefore sit at the intersection of structural support from AI and energy transition themes and very high event risk, making the timing and sizing of exposures as important as the long-term directional view. Stepping back across assets, we see an equity market where earnings breadth and AI-driven productivity support a broader rally, but where valuations, leverage positioning, and central bank politics keep drawdown risk alive. Rates look range-bound on the surface, yet the tug-of-war between weakening labor data, fiscal expansion, foreign demand, and Fed succession uncertainty leaves term premia and curve shape highly sensitive to new information. Credit continues to provide carry and relative calm, even as issuance surges and AI-related capex, commercial real estate bifurcation, and a K-shaped consumer backdrop introduce more idiosyncratic risk, while FX and commodities increasingly reflect the same themes of policy divergence, the dollarization narratives, and a possible shift from tech-centric to resource-centric leadership. Over the next few weeks, allocators will be watching payroll revisions, inflation prints, Fed and Bank of England communication, the progress of U.S.-Iran diplomacy, and the reception of large bond and equity deals to gauge whether today's rotation stabilizes into a new regime or gives way to another bout of volatility. This video is for information only and is not investment advice. Visit and subscribe to vTalkInsight.com for latest interactive market insights.